Want to learn how to save potentially thousands in tax this financial year and boost your super by potentially hundreds of thousands in the process? Then listen up, because 30 June's almost here. This tax saving strategy works by making an additional contribution into your super fund before 30 June and claiming that amount as a tax deduction. This falls under a concessional or before tax contribution. There are three types of concessional contributions. The first type are your employer superannuation guarantee contributions. That's basically that 10.5% that goes direct from your employer straight into your super fund. The second type are salary sacrifice contributions. That's when you're making an additional portion of your salary go straight into your super fund and bypassing tax. And the third option are personal deductible contributions. That's when you're using your extra cash to put it into super and claiming it as a tax deduction. Each financial year, there's a maximum that you can put in, and this financial year, it's $27,500. Let's run through a quick example scenario so I can show you how the tax savings work. So let's say, for example, you're on a salary of $150,000 a year, and your employer is making that 10.5% SG contributions of $15,750. Now let's say you're not making any additional contributions into super, so that's your total amount there. So don't forget, each financial year you've got a cap of $27,500. So you've got a remaining cap that you haven't used of $11,750. Now that's wasted potential. Now let's say instead of wasting it, you're utilizing that $11,750 to make a personal deductible contribution into super. So that brings your total contributions of $27,500 for that financial year. That means you're maximizing your contributions and utilizing your cap. To quickly show you how this is taxed, in the current scenario, we're not making those additional contributions into super. So you're paying tax on your salary, 150 grand, at your tax rate, 37%. So that's how much tax you're going to have to pay. So 43.5 grand, which is very costly. On the other hand, if we made that personal deductible contribution of $11,750 into super, we can claim that as a tax deduction. So instead, you're paying tax on that amount there. So this is how much tax you'd have to pay. Now, when you make concessional contributions into super, there's a 15% contributions tax, which is this amount here. So basically, that minus that, your net tax savings are $2,820. So as you just saw, there's potential to save thousands in tax using this strategy. And not only that, you're putting your money into super, which means it's going to grow more over time. And if you maintain this strategy over multiple financial years, not only are you saving thousands each year, you're boosting your super as well, which means you can have potentially hundreds of thousands over the long run. Please remember, guys, this is general advice only. It's best to speak to an advisor like myself to make sure, number one, it's appropriate for you. And number two, if you're going to actually go ahead with this strategy, make sure it's implemented correctly to avoid any tax penalties and so you can actually get that tax deduction.